Hello everyone, thanks for checking out my video. There is currently one phenomenon in the US stock market, and that is dip buying. So last Thursday, all three major averages took a sharp reversal and plunged towards the end of the trading session. They all fell more than 2% off their intraday highs. But on the very next day, almost the entire stock market rebounded as dip buyers swept up stocks at discounted prices. It seems like dip buyers kept stepping in whenever they saw a little blood on the streets, as every pullback in the stock market has almost immediately met with a rebound. But just how long can this phenomenon last? Well, they say the higher you climb, the faster and heavier you fall. Will this happen in the stock market soon? Let's cover these topics in this video. As usual, do stay throughout the video to find out more. The US stock market ended higher last Friday as investors struck off the anxiety that surfaced on Thursday, where the market saw an ugly intraday reversal. So here's what happened in a nutshell. Last Thursday, one of the Fed officials was ultra hawkish, as he mentioned that he had only projected 2 rate cuts this year. On top of that, he also cautioned that if we continue to see inflation moving sideways, then that would make him question whether the Fed needed to do all these rate cuts at all. That's double kill. Then, lo and behold, he further went on to say that the rate hikes are certainly not off the table, although the scenario is unlikely at the moment. So that's triple kill. I mean, from 3 rate cuts to a potential rate hike? Honestly, I don't know what this guy is smoking, man. Anyway, when the market received this news, it plummeted, as you can see from this chart. To add on the very same day, oil prices hit their highest levels in 6 months, causing worries about a surge in inflation again. Okay, just when some bears thought that the market is about to have a decent pullback or decline, on the very next day, Friday, the market rebounded. Not sure what's the real reason behind that bounce, but it was evident that the dip buyers were stepping in again. Anyway, on Friday, the US released the latest non-farm payrolls data, which shows an increase of 303,000 jobs in March, more than the expected 212,000. In addition, the unemployment rate came in at 3.8%, a decline from the previous month of 3.9%. For this particular set of data, it really depends on how you interpret it. Some may see it as the job market is very hot and may reignite inflation fears. But on the other hand, some may see this as a sign that the US economy remains resilient amid a fading expectations of rate cuts, and that both the companies and economy are adapting to this high interest rates environment. Nevertheless, almost every sector in the S&P 500 ended higher on Friday. Moving over to market outlook, well, things will come in thick and fast this 2 to 3 weeks. We have CPI data, PC index, jobless claims, earnings season, etc. before the next FOMC meeting on 30th April and 1st of May. But let's zoom into this particular week, where the focus will likely be on the CPI data for March, which the market expects a smaller monthly increase than the previous prior 2 months. The data to be released on Wednesday, 10 April will definitely be closely analyzed by the Fed ahead of their next meeting at the end of the month. On the same day, the meeting minutes of the previous FOMC meeting will also be released. Alright, apart from CPI data, there are also the Producer Price Index and initial jobless claims reports to watch this week, which both will be released on Thursday, 11 April. Another thing to highlight for Thursday is that there will be 4 Fed officials speaking. Maybe to add on to this, there are 2 more Fed officials speaking on Friday. Okay, the reasons why I highlighted this is because, first, these Fed officials are speaking right after the release of the new CPI data. Second, I found it very interesting how all these Fed minions came out 1 week after Powell's speech to contradict Powell's words. In short, there have been a bit of inconsistency in the speeches from the various Fed speakers. So let's see if that happens again this week. I am quite sure the market will be monitoring and interpreting the Fed officials' words. to see whether the latest burst of hawkiness from these minions will delay the long anticipated rate cuts or not. Let's now move over to the technical analysis segment. Well, it appears to me that the broader market is taking a small break now as SPY has been moving sideways. As you can see from the chart, SPY has been trading this range between 510 and 524. In my personal view, I think the next big movement will likely only come when the earnings season starts. But meanwhile, for this week, as mentioned earlier, we do have a few key events that could potentially move the market. And in my view, no matter how SPY moves, it can have that huge intraday sell-off we saw last Thursday or have a huge pop on any day, I will not be fazed by it, as long as it's moving between the consolidation range of 510 to 524. Even if SPY drops slightly below 510, that's fine as well. What will keep me on my toes is when SPY goes below the 50 moving average, as that presents a potential change in trend. Because if we were to zoom out the chart, you can see that SPY has not fallen below this 50 moving average since it went above it in November 2023. Therefore, if SPY goes below that level, it says a lot about the bearish price action. When the 50 moving average gets breached, there is a high chance for SPY to head towards the gap between 495 to 501. Okay, I know it's a long shot for the bears, but the bears have to take out the all-important 61.8 Fibonacci retracement level at 487 to cause any sort of alarm in the market. And if we ever get to this level during the earnings season, then the overall price action and market sentiment would be very, very bearish. I will definitely be buying the dips though. On the other hand, if the recent consolidation phase is just a small breather that the market is taking, then the bulls would want to see SPY closes above the resistance level of 521 for maybe at least a week. SPY did actually close above that level for 3 days previously, but fell below it again. So for full-blown breakout, I think we need to see some strong corporate earnings, and that's when I would expect SPY to break the recent high of 524 and charge towards 536. By the way, let me show you something interesting. So last Thursday, we had the huge intraday sell-off, and it created a bearish engulfing candle. But then, on Friday, we saw a bullish harami candle forming. To me, this shows a bit of a tug of war between the bulls and the bears at the moment. So with this, my sensing is that for this week, SPY is likely to continue its movement within that range that I have mentioned earlier, as we are about to enter the new earnings season. But of course, I could be very wrong. Okay, moving over to Apple's chart. To be honest with you, I thought Apple will find its new direction last week, but it didn't, as it moves towards the very end of this descending triangle pattern. And in case you're not aware, descending triangle is a bearish pattern. Well, since the edge of this triangle is running out of space, I guess Apple has no choice but to let us know where it's its new direction this week. A break below this triangle and below 165 is bearish, because it would mean that the support area of 165 to 168 has been breached. Not just that, it would also mean that the MACD will have a bearish cross. From there, okay, I could be wrong, but I do think that Apple will continue to glide towards 150's range. Well, it may not happen in 1 week, but yeah, below 165 does open the door to below 160 to the 150's range. That's when the gap between 157 and 158 could be filled. On the other hand, if somehow the descending triangle fails to materialize and Apple breaks above it, that's slightly bullish. But for confirmation, we need to see Apple reclaim 175 at least. As you can see from the chart, we have a few false breakouts or pick-a-bull days above the purple downtrend line on a few occasions. And then Apple went back down. So to convince me that there is a change in trend, I would want to see Apple going above 175 convincingly. When that happens, then yes, I would say the bullish thesis is playing out, and Apple could grind towards 179 where the next Fibonacci level and the 50 moving average converge. this is one level that I would expect sellers to step in. In order for bulls to regain full control, they will need Apple to climb above the 200 moving average at 182, but I think that's quite far-fetched this week. If anything, I think Apple needs some solid earnings results to bring the stock price above it. Well, I will continue to update its movement as we go along, so do stay subscribed to not miss any of my updates. Let's now move over to Tesla. Wow, it has been a very dramatic week for Tesla. The company's delivery numbers for Q1 of 2024 had missed estimate by the most ever, as it delivered only 386,000 cars. This is a decline of 8.5% year over year and way below the estimate of 457,000. As a result, the stock price plummeted on Monday when the numbers were announced. But somehow miraculously, the stock recovered on Tuesday and Wednesday to where it was before the announcement of the delivery numbers. And just when we thought all bad news have been priced in, Tesla announced that they are slashing their vehicles price once again. But the heavy blow came when Reuters reported on Friday that the company is pulling the plug for its low-cost vehicles, and Tesla stock suddenly plunged 6%. But then, shortly after, Elon Musk went on X to respond to a tweet by saying that Reuters is lying again. After this tweet was posted, the stock recovered 50% of its decline almost immediately, but still closed the day in the red zone. And then, after the market has closed, Musk said on X that Tesla would unveil a robo-taxi on 8th of August. Despite no other details, the share price popped 3.8% during after trading hours. What a week we had for Tesla. Sorry, I just have to cover all these dramatic events. Actually, this short-term news will affect the technical analysis. Okay, first of all, Tesla's chart is still looking bearish as it broke below the bear flag. To be honest with you, I thought it will continue to fall towards the 150s range, but somehow this 160s range appears to be a decent support area. Some whales are protecting this area, and one of them is Cathay Wood. And now with the post-market euphoria based on Musk's robo-taxi tweet, things will get very interesting because on one end, Musk is pumping the share price, while on the other hand, the technical chart remains bearish. So anyway, if the euphoria couldn't last this week and somehow Tesla breaks below this 160 support area, then the MACD will likely have a bearish cross. This is when I think the floodgate will open. And the next target will be the gap at 146 to 152, which coincides with the bottom of this downtrend channel. Okay, meanwhile, I would like to take this opportunity to thank the following viewers for your generosity, as this is not the first time you have supported the channel either by Super Thanks or Ko-Fi. For other viewers, if you would also like to support this channel, do consider either option. Otherwise, you can simply tap on the like and subscribe buttons. That will be very helpful as well. Thank you. Alright, so on the flip side, if Elon continues to pump the share price, we could have a near-term bounce. But I wouldn't consider Tesla being out of the woods unless it can go above 177 at the very least. Note, that's the very least. For me to say that Tesla is on a bullish momentum, the prerequisite is to reclaim the 50 moving average and fill the gap between 184 to 186 without getting rejected. A solid close above these two resistance areas will then open up more upside towards 190s range. If Tesla does not get rejected at 188 to low 190s, wow, the upside potential is actually quite massive. We could be seeing the top of this downtrend channel, and that's the low 200s range. Okay, but given the recent headwinds and the earnings coming up, I am not too confident that Tesla will reclaim this 200 level anytime. If anything, I think we can expect some rejection at either of the resistance levels that I have just mentioned, namely 177, 184 to 186 area, as well as sub 190s. I could be wrong, but let's see. I will continue to provide updates via my videos, so do stay subscribed, alright? Finally, let's check out Google's chart. When Google broke the recent high of 153, I really thought it could grind up to 160. Well, it did not happen last week, but doesn't mean the thesis is invalidated. So let's check out what signs do we need to see for Google to hit that 160 level. First of all, as shared in my last video, Google obviously has to shake off this sticky uptrend channel line. It has been hugging it since 18 March. Anything below it means Google is lacking strength, and then of course the bullish thesis towards 160 will be invalidated. Okay, but let's still give Google some credits as it did break and stay above the trend line for 3 days. Just that it couldn't sustain its momentum because of last Thursday intraday reversal. Come this week, I would expect Google to continue to test this trend line, and let's see if it can finally break free from the line. If it goes above the trend line again, we could then see another all-time high, and this means the route to 160 is still intact, just that the stock needs a bit more time. But if we get rejected, don't worry, we have a few support levels below, namely 150 and 146. I think we can watch for potential bounce from either of these levels as Google takes a break. But if these two levels get breached, I think bulls have to be very cautious because can you see that MACD? It is on the verge of crossing down. So if the two support levels get breached, the MACD will likely cross down and it could be a start of a new short-term bearish trend. Below the 150 and 146 levels, watch for the 50 moving average at around 144 and more importantly the critical 61.8 Fibonacci level at around 140. The latter is a critical support in my opinion. But if Google doesn't bounce from that critical level, I will be looking at selling cash secure put with a strike price of around 135 where the 200 moving average sits. If you have been following me, you would know how strong a support this 200 moving average is. And unless we can get some really negative news from their earnings, I don't think we would break below that in the near term. Moving on, let's now check out my options trades. Last Friday, 5th April was a dramatic day for this particular cash secure put on Tesla. Basically, the strike price for this contract was 160 and was set to expire on the very same day, 5th April. But during intraday, Tesla suddenly plunged on the rumors that Tesla is scrapping their low-cost car plans amid fierce competition in China. At one point, the share price fell more than 6% and almost breached my strike price as it went as low as 160.5. At the same time, the contract was worth $1.75, which was higher than what I sold for at $1.65. In other words, if I had panicked and chose to close the position by buying back the contract, I will incur a loss of 10 cents, which is $10. I know $10 is a very small amount, but can you imagine the trade was up 99% at the start of the trading day, and within 30 minutes, the entire gain got wiped out and I almost had to incur a small loss. So I guess this is one takeaway for viewers out there, which is to monitor your position on the expiration date, especially for volatile stock like Tesla. Otherwise, if it suits your style, always take profit by closing your position earlier. But that's not my style, just saying. Anyway, Elon Musk later came out to save the day by replying to a tweet saying that Reuters is lying. And suddenly, Tesla's share price recovered in a matter of minutes. What a roller coaster ride. So what happened after that was Tesla continued to trade around 163 range and closed the day at around 165, which was above my strike price. As a result, my put contract expired worthless and I got to keep the full premium of $165 without having to close my position. What a close shave. Next up, on the very same day, 5th April, I also sold a new cash secure put on Microsoft. The strike price is $390 and expiration date is 10th of May. There are a couple of reasons for making this trade. First and foremost, Microsoft looks like it is in a consolidation stage to me, and by now you should know that such sideways movement benefits an option seller. Secondly, last Thursday we had that bizarre intraday huge reversal in the entire US stock market. So the very next day I was watching the overall market and Microsoft to see if the sell-off continued, and apparently it didn't as the market rebounded strongly. As a result, I decided to ride this bullish momentum and sold a cash secured put, which is a slightly bullish move. Finally, can you see the Fibonacci lines that I have drawn? Microsoft has been floating above the very first Fibonacci retracement line since mid-March, which appears to me that dip buyers kept stepping in around this area, thus making it a decent support. To add on, I had given myself some buffer by selecting a strike price that is the same as the critical 61.8 Fibonacci level at around 390. This is one strong support level for potential bounce. Basically, in order for my strike price to be breached, Microsoft needs to break that first decent Fibonacci support level, the 50 moving average, as well as the all-important 61.8 Fibonacci level. That's a total of 3 big support levels to break. Not saying it's not possible, but the odds are low, at least in my opinion. And just to also highlight, the 50 moving average has also proven to be one solid support level since Microsoft embarked on this monster run that started in October 2023. I mean, as you can see from the chart, whenever Microsoft went near the moving average, the share price rebounded. But if all else fails, well, Microsoft at 390, given its strong fundamentals and exciting AI projects, I am sure many people would want to buy it below 400, so I may not mind getting a side at 390 to be honest. Well, I will think about it again if my strike price gets breached. Okay, right now I think we are at a junction where the whole inflation and rate cut situation can be seen as glass half full or glass half empty. In layman terms, half full means optimistic and half empty means pessimistic. Clearly, last Friday, the Wall Street decided to take on the glass half full perspective by rallying on the basis that the job market and economy is so strong right now, so even if the Fed pushes back their rate cuts, it is okay. This is reflected by the odds of a rate cut in June falling from more than 70% 2 weeks ago to at about 50% as of the date of recording. It seems like the market is slowly accepting that the first rate cut may not come in June. That being said, nerves may run high this week if the CPI numbers come in unfavorably. On top of the new inflation data, pay special attention to the growing tensions in the Middle East as well. If the oil prices continue its surge, the market may not like it as it may reignite inflation fears. Okay, I know at the moment it appears that the bulls have an upper hand over the bears as they took on the optimistic glass half full perspective. But I believe that as the market continues to push back the Fed rate cuts, potential stagnation of inflation, Treasury yields hitting a new 2024 highs, oil prices surging, these headwinds could potentially take a toll on the market. Okay, just to clarify, by saying so, it does not mean that we will see a big crash soon. It could just be a small toll or break. And by sharing these headwinds, it's also for viewers to take note just in case you are not aware of any of them. In fact, I am also trying to keep myself in check so that I don't get too complacent or chase the euphoria. Lastly, all this macro environment stuff aside, we are about to enter a new earnings season from next week onwards. That is when you can expect to see individual stock prices experiencing huge swings or movements. And if you are trading options, you gotta be extra careful, man. Okay, all in all, it is going to be a bumpy week and month ahead. And what is your trading and investment plan for this month? Do share with me in the comment section below. Alright, that's all for this video. Do remember to tap the like and subscribe buttons before you exit, okay? Thank you very much.